Well, it's about 5:30, everybody. Let's get started. And I want to welcome most of you back and welcome to some others who are just joining us today. We're happy you're here with us, and we're hoping you're happy and healthy in these crazy times. You just missed me scolding the dog because he was chasing the UPS driver. I suspect that's probably happening all over the country as we do these remote and Zoom conferences. There's always something going on different. I'm coming to you from a quarantine location, and Sharon Head is leading us from the AP Wealth World Headquarters in Augusta, Georgia. And as always, Sharon gets us through this stuff, and I'm going to ask Sharon to just review how you can ask questions at the conclusion or ask questions via chat during the course of the briefing. Sharon?
Sure. Thanks, Gene. You can ask as you've been doing, but for those who are new, probably the chat box is the easiest place. You can send a message to everyone or to me privately, and you can state your question, or if you would like, you could just say that you would like to ask a question, and we can unmute your mic at the right time and let you ask. So if you'd like it to be more interactive or to follow up with a question, you could do it that way. So let me know if you have any problems. You can call the office, and we can help you out if there are any problems with the locating the chat box. Thank you.
Sharon, will you be our technical support representative today too?
Yes, Millie's here as well.
Oh, Millie. Hello, Millie. Thank you, Millie.
Yeah, she's over there. So if anybody needs to call in, she'll probably catch your call.
Terrific. And thank you, Millie, and thank you, Sharon. We have a great team at the office as well as everybody else there. Well, today we're going to talk about the markets, just an update. I should stay out of the office more because we have good days when I'm out of the office. And we're also going to talk about our approach and how we're doing what we're doing today. And then most of all, hopefully, we'll get some good questions from you guys on what's happening in the markets or otherwise. And then, of course, at the end, we'd like to solicit your suggestions for future briefings. These have become very popular, and we're thankful that they are because we do think communication is incredibly important during these times. And we're also, as you know, very grateful for the confidence you placed in us in these strange times. So the markets, today was a good day. Who knows what tomorrow holds, but the markets are beginning to stabilize, and they're beginning to stabilize because we're beginning to see some elements of certainty. Although the news is not good in many of the large cities, we're beginning to hear about peaks. And of course, after a peak would be hopefully a respite or a slowdown. So as we talked about in our first briefing and subsequent briefings, what the markets cannot stand is uncertainty. So as we get some uncertainty, I think that's why we're seeing some stabilization in the markets. Have we hit the bottom 2 weeks ago or a week and a half ago? I don't know, but the signs are certainly getting better, and we'll talk briefly about that today, and hopefully you'll have some questions. As I was preparing for this, what is equilibrium? Where should we be on a valuation standpoint for entity indices? The one that gets the most press is the Dow Jones Industrial Average. There are many that we follow, and I'm sure some of you are aware of those. But I don't know what equilibrium is, but at 29,000 on February 21st, which was an all-time high, was that realistic? I'm not sure. If you had meetings with us, you knew that we said 2019 was a great year. 2020 is not going to be as good. We certainly didn't expect it to be like this. No one did. But was a 30% increase in the equity markets in 2019 realistic? Probably not. So some of this downturn could be masking a correction, which we all knew had to come. So where will we find ourselves? I don't know, but we'll talk about it in just a little bit. Some other indicators that we look at are the U.S. Treasury yield, the 10-year U.S. Treasury bond. So if you buy a bond from the U.S. government now for 10 years, it's yielding 0.7%. So you'll make $7 on a year on a $1,000 bond for 10 years. That is a historically low interest rate and is very germane to what's going on because people want to buy U.S. Treasury bonds. So when a lot of people want to buy U.S. Treasury bonds for safety, the government doesn't have to pay as much interest on them. Also, oil is at $24 a barrel. Both of those, the 7.7% rate and the $24 per barrel for oil, are close to historic lows. And that indicates some weakness in the market. Of course, with oil, there's a couple of other things going on, but demand is just not there. And we can see it in what's happening all around us by having to go to restaurants for takeout, no hotels, no airplanes, and so forth. But as we see some certainty come into the markets, I think those will improve. Just a couple of points that I was taking a look at as I was preparing for this. We're 1,000 points above where we were on the Dow Jones Industrial Average on December 31st of 2018. Let that sink in for a second. December was not a good month for the markets, but it was about a 10% decrease. But we're 1,000 points above where we were on December 31st, 18. And as I looked at some other figures, we're 1,200 as of today's close, 1,200 points below where the Dow closed on June 3rd, 2019. So we're beginning to get back, if you will, and I don't think back was 29,000 on the Dow Jones Industrial Average on February 21st. So, of course, we talk sometimes about price earnings ratios or PE ratios. We want to see a low PE most of the time. Price to earnings, that means the markets are typically fairly valued. That number historically is about 16. We're just below that right now, which sounds really great. That's because prices have come down in that equation and earnings have stayed the same for now. So we'll get first quarter earnings at some point soon, and it's not going to reflect a terrible quarter for the whole year. Of course, the last month in the quarter will be poor. But what happens to that PE if earnings go down? That's something that we look at. And the reason I bring it up, I'm trying not to get too technical. It's probably something you're going to read or hear about. So if you hear of a good PE, i.e. that being lower than the historical average, that's a good sign. But we also want to see what happens in the second quarter to earnings. So I hope that helps a little bit on what we see going in the market. If there's something that I didn't address that you're interested in, of course, please put it in the chat box or have Sharon help you with some of those questions. So let me work on my technical skills here. Okay, let's close this. I'm going to reboot here. Bear with me, y'all. Okay, there we go. There we go. Okay, let's back up here. There we go. All right. So that was my market update. I'm not very good with slides yet, but I'm working on it. This is something that you see all the time. We're not going to talk about this, but we're going to talk about something else for a few minutes. And this is our inverted triangle, which is asset allocations at the top and security selection or stock picking is at the bottom. We'll reference that. But I wanted to just talk briefly before we took questions about how we are investing now. And as I posed that question to myself, the answer was the same as we always have. We're going to take a disciplined approach, and the cornerstone of that is going to be asset allocation. We have some core principles that I'll share with you that I may or may not have shared with you before. And there's four main ones. There's many others, but asset allocation, appropriate asset allocation, always leads to good decisions. Does it always lead to good results? Not necessarily, but it leads to good decisions. We rebalance 2 times a year. Now, that's typically in May and typically in November. We talked in our strategies about rebalancing and how that's important these days. And we don't rebalance all at one time. So if we're going to rebalance in May, we'll begin looking at portfolios for rebalancing way ahead of time and slowly move in or move out of positions. So that's the second one, rebalancing 2 times a year. Then this one I'm going to spend a little bit of time on today, and that's our custom design of our portfolios. There's 4 model groups: attain, relative return, opportunistic, and protect. So we use asset allocation to make decisions, and then we have a subset underneath those, which are those 4 model portfolios. And then 2 other things that we look at are stock positions are typically not going to be less than 3% of a portfolio. If we're buying 1% of a stock, it's usually not going to move the needle. And then a mutual fund position is typically going to be at least 5% of a portfolio. If we're buying less than 5%, it's probably not going to move the needle either. So let's talk about, y'all have seen this screen, and I'm going to take it one more. These portfolio groups down in the bottom right-hand corner is what we're going to focus on a little bit today. So these are them, a little bit larger, and I'm going to walk through them, but I'm going to focus on opportunistic. So attain, these are our 4 groups. Attain is where we invest in the market at the lowest possible cost that we can. So we might buy, as an example, the S&P 500, an exchange traded fund or an index fund, because that means we're buying the entire market at a very cheap price. It's just whatever's in the S&P 500 is what a client's going to own. And that's going to move up with the markets and move down with the markets. So that's called attain. Relative return, the second one down, is where we will outsource some decision making, typically to a mutual fund, or if we buy something like Berkshire Hathaway, to Warren Buffett, where we don't want to outsource all of the decisions because people don't know what our clients want and need, but we certainly value expertise of others, and we'll use those in the relative return. Another example, one of our favorite funds is T. Rowe Price Capital Appreciation. There are a host of others. I'm going to skip opportunistic and come back to it here in a second. Protect is where we invest conservatively, and it's typically fixed income oriented. We don't care what the equity markets are doing. We are going to invest in bonds, in bond funds, in things we know that are not going to be volatile. And so our secret sauce after asset allocation is how we allocate a percentage of attain, relative return, opportunistic, and protect for our client's particular situation. Sometimes that's based on our knowledge of them. Sometimes that's based on their profile being very conservative or very aggressive. So let me move to opportunistic, because that is where we will use times like this to make some judgment calls, to look for some value. You can see that word value approach there. Where do we see value? And we got a lot of questions about this in the last couple of briefings, so I wanted to touch on it. There's a target-rich environment right now for investments. A lot of things have been beat down a lot, from consumer staples and consumer cyclicals to airlines to hospitality to energy. So this is where, opportunistically, where we would focus on those undervalued assets, and we'd make an allocation to those undervalued assets. It's not separate from what we're doing. And really, attain, relative return, and protect are the blocking and tackling. If we've done our homework right and we look at those and we do the research on what we have in those should not change except when we rebalance. Opportunistic is where we take advantage of decreases in the market, and we'll often rebalance to those. And all of this comes from our investment policy committee meeting. So about once a month, we have an investment policy committee meeting where we get together and we talk about what's in our attain, what's in our relative return, what's in our protect, and are they doing what they're supposed to do? And then we also talk about opportunistic. Where are some areas of opportunity? I just mentioned some, and we'll have that meeting on Monday. We also had an emergency investment policy committee meeting last week because the markets were moving so fast. We wanted to be in contact with each other. But it's a really good exercise for all of us on the team because we challenge each other and we dig into what we're holding and where we're holding it and how it's doing relative to its indices. So before I forget, before I take questions, that's a thought. If you would like to hear next week about the results of our investment policy committee meeting on Monday, I thought maybe that's a good topic of something that you might want to hear. So with that, I'm going to quit talking and take any and all questions that you might have. I've got plenty of time, and I'm happy to answer it. And my chat box is not showing, so Sharon, until I get it up, if you'll repeat the questions, that would be great.
Right.
I'll work on that.
Sure. We don't have any questions unless someone has sent them privately to Eugene.
Okay, so let me see if I can get my chat
anything.
box up here.
Yeah.
All right. Bear with me, all. Okay, there it is. Okay. I don't see any yet, Sharon.
Right.
Done a really good job. Yeah.
You answered everyone's questions.
Yeah. Here, I'll move that. There we go.
We do have a question that, Gene, why are you in quarantine?
I'm not sick. I just didn't want to infect anybody or be infected. So, and we were going to be out. This week was supposed to be Masters Week, so we were going to be out anyway. So it's a good time for me to escape for a little while. And I think I can sometimes get more work done out of the office than in the office, and I'm certainly not bothering Millie and Sharon and everybody else there, so they probably like it. Okay.
We miss you.
Oh, you missed me. Thank you, Sharon.
Yeah.
This is a question. Seeing low rates and the likelihood of higher rates in the future, should a higher cash allocation be considered? That's a very good question. And as a matter of fact, one that yes, it should be, because when rates rise, bonds are going to struggle. And I'm going to expand on that a little bit. We took an opportunistic stand back in August, September of last year. Rates unexpectedly dropped a lot. So that means, without getting too technical, preferreds, utilities, REITs, income producing investments did very, very, very well. And so we went out of a lot of those, and some bond funds as well. We went out of those to some cash. And fortunately, we stayed in some cash. So the question, the point of the question is, if you're in bonds and rates go up, you will suffer. Is it best to be in cash? So we're a little overweight in cash right now. I hope that answers the question, Russell.
Okay, we have another question, and it is, I lost it. When you rebalance, is it still with an eye towards long-term?
Always towards long-term. That's a good question. And as just a reminder, asset allocation is based on risk tolerance and time horizon. So if your time horizon has not changed and your risk tolerance hasn't changed, then yes, it's always towards the long term. Now, long term means different things for different people. If you're getting ready to retire, long term might be 3 years. If you're some younger folks on this call, that could be 30 years. So it's all relative, but we always try to look to the long term, whatever that is for clients. Yep. Good question.
Okay. Yeah, thank you. The next question is, it appears there are a lot of opportunistic options in the market right now. Could you go into more detail on how the team looks at opportunistic stocks or funds and how that looks for a typical portfolio?
Good question. So we will look at sectors first, and then we'll look at how do we want to get that exposure in sectors. I'll use energy as an example. I referenced that oil is at $24 a barrel, which is very, very, very low. So if we wanted exposure and we thought oil was going to come back at some point, we don't know how fast. How would we go get that? We could go buy stocks. We could go buy ETFs. We would also look at things like yield. What are they yielding? We'll look at airlines, and we look at their historical averages, not just their performance in the last 3 weeks, which has been poor for a lot of things, but we'll look at their historical averages. We'll also look at their PEs. I referenced PE earlier, price earnings ratio. That's very important. And then probably most importantly, we'll look at their balance sheets, because if there's a really strong company or industry that's performing poorly in its industry because the industry is performing poorly, that's a different measure than if it's performing poorly because its financials are not good. So we'll dig into the balance sheet of those various investments.
Okay, I don't have anything else right now.
Well, I'm going to sit tight because there's no such thing as a stupid question, and I'm not a good explainer of this technical stuff, so feel free to ask away.
Okay, we have another question. With the government spending all this money, are you worried about inflation?
We have the smartest clients and attendees. They are spending a ton of money. Yes, ma'am. And it sounds like more is coming. At some point, inflation is going to be a problem. We've been saying that for 5 or 6 years now. And a great measure of inflation is that set 0.7% yield on the U.S. Treasury bill. That indicates very, 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 very low inflation and almost deflation. But at some point, spending like a drunken sailor is going to catch up with us. How fast that happens is anybody's guess. But the first thing that's got to happen for us to have inflation is we have to have growth. So without any growth right now, with actually us going in the opposite direction, we're not concerned about it in the near term, but certainly in the long term, we are concerned about inflation, and we'll address that. Great question. And I think I mentioned this at the last briefing. And I see another question popped up. Taxes. With our demographics and the money that we're spending, we're at a historically low tax rate, although it doesn't feel like it. At some point in the future, that's probably 5 or 6 years out, that's another way that we're going to have to pay for this. So do you ever look at pharmaceuticals? Absolutely, we look at pharmaceuticals. And I was just listening to a podcast today. I'm listening to a lot of podcasts and reading a lot. Pharmaceuticals and healthcare indirectly, although we have a dysfunctional healthcare system, have actually performed pretty well over this 3-week period and will probably perform well going forward. Who will create a vaccine? I'm not sure anybody knows. When it will come out, nobody knows. I think it was Moderna had pledged they were working on a vaccine. The first 1.5 million vaccines were going to be free. And then should it work, that was for experimental purposes, should it work, they were not going to charge for the remainder. I see we've got another question. I've heard a few advisors say time is different. Demand shock and standard playbooks need to be reconsidered. Any concerns along these lines? Another good question. In the short term, it could play out a little bit differently because we've never had a pandemic in my lifetime, and I think the most recent pandemic of this nature was probably the Spanish flu in 1918. But long term, I think it's going to play out exactly as other crises have played out. And in the interim, if we have a different playbook, I don't think anybody knows that playbook because we haven't been there, but we haven't been here before. So it would be speculation to try to make up the rules, in my opinion, as we go along. One of the questions previously was, should you have a larger amount of cash rather than bonds? I think that's good. And as I mentioned, we're overweight cash. Another question, many of those who still have jobs we know have been asked to take discounts in their salaries. They may be permanent. Do you see possibilities of deflation in the short term and will commodities follow? So deflation, that is a great topic that is a dangerous topic, because deflation is actually scarier than inflation. Deflation means we don't have enough buyers of goods, in so many words, unlike the flip side where we have too many buyers for too few goods. No, I can't tell you when. Certainly the U.S. Treasury yielding 0.7% is alarming and concerning, but I do believe we're going to have pent-up demand. When that demand comes out is anybody's guess, but at some point we're going to have pent-up demand. People are going to have money to spend at some point. These salary reductions and furloughs may be permanent. I sense in the long run they're not going to be, because we're going to have a cyclical recovery from this. What'll be interesting, though, is how this affects us business-wise, communication-wise. I think there's going to be some things that come out of this that we're not, we can't even imagine right now. And by way of example, the Zoom platform that we're using right now, I looked at the stock just out of curiosity to see how it was doing, and it's had a nice run up. But the head of Zoom, the creator of Zoom, said we let it out too fast, and there was some security issues, which of course we have addressed. But it was interesting to see his take on it.
Let's see, Gene, I've received a question here. It says, do you anticipate most small businesses that or did you just do that one? That layoff will rehire once the shelter, no, you didn't. So do you anticipate most small businesses that lay off will rehire, or once the shelter in place resolves, will things bounce back slowly or more rapidly?
My guess is slowly. I think they'll bounce back, to reference the previous question as well. I think they will bounce back, but I think it's going to be slower than most people think. And I am certainly no physician and not an epidemiologist, but my sense is, in doing the limited reading I've been doing, the biggest fear is that we have a recurrence of this. We all start to feel better, and we let our guard down, and we have a recurrence of this, which would be just disastrous, because if you did hire people back, you lay them off and furlough again. So I think we're going to need to really, really, really be patient as we move forward. More patient than we have been. Like we have a college student home with us, and when she got home, I said, Cecilia, this is great. I love having you here. I suspect in about a week and a half, you're going to be sick and tired of me. And I was a little long in my estimation, because after about 7 days, she was sick and tired of me. But we're making it and getting along. While we're waiting for another question, I want to go back and revisit what we saw at February 21st in the Dow at 29,000 and a 30% return last year. I think, to the question you just asked, and to the question that's probably on everybody's mind, is where are we going to end up? I think, I don't know the number, but I think the number is somewhere between 29,000 and 23.3, or whatever the Dow closed at today. It might be 25,000. I don't know. But it's also going to certainly depend on how earnings come out. And when we were at 18,000 or 18.3 on the Dow about 2 or 3 weeks ago, that was folks projecting how bad earnings would be, how many folks would lose their jobs. And I think they overshot the mark. Who knows? Nobody knows. To a previous question about, is this time different? Is there some demand shock? There could be. That's just my sense. Well, as we begin to think about wrapping up, I'm still going to entertain a little bit more time. Please send us some feedback on what you heard today, what you've heard in the past, either via email or call us or whatever. We want to give you information that's meaningful to you and helpful to you. There's a lot of information out there. We certainly don't have all the answers, but we want to be a guide to you and maybe tell you where to look. So if there's something that you'd like to hear us talk about, if you like this format where we do a market update and then you have the opportunity to ask questions, that's terrific too. If you like the thought of us reviewing what we talked about in our investment policy committee meeting, which should be interesting Monday, happy to report on that. All right. Do you think the best time to enter the market is the end of the second quarter? Another great question. I have no idea when the best time to enter the market is, if I'm telling you the truth. It depends on where you are in your life, where your risk tolerance and time horizon is, and we don't know. This could be the best time. It could be the end of the second quarter. It depends on the recovery and what's happening. So I can't tell you the best time to enter the market. I think, well, I'll tell you a quick story. I have a client in Virginia who is an emergency room physician, and he was also a finance undergrad major at University of Virginia. So he's a very interesting guy and has a lot of knowledge. And he was very concerned about the markets. And so we made some changes in his portfolio. And the next day, the market went up by 700 points. And he said, I guess you're really in awe of my forecasting. I said, in the long run, it won't make a difference. And to your point, when you get in, is it the second quarter? In the long run, trying to time the market or getting in at just the right date doesn't make a difference. It makes you feel good in the short run, but in the long run, it doesn't make a difference. What are my feelings on Bitcoin now? To be honest with you, I know a little bit about Bitcoin. I really don't follow it much. I know it's been very volatile, but the bottom line for me is the Federal Reserve is not going to let Bitcoin become a currency of choice, either in the forefront or in the background. It's going to do everything it can because we can't have alternate currencies out there. So that's my take on it. I hope that helps. Well, I'm going to thank y'all for attending. Encourage you to send us your feedback. That's very, very valuable to us. Also, take care of yourselves, wash your hands, and as I said last week, check on somebody who you haven't talked to in a while, and make sure they're okay. I think in these times of Zoom and FaceTime and telephones and so forth, just to know that somebody's thinking about you is really a special way to take care of folks. So my best to all of you. Please take care of yourselves. We're grateful for the confidence you placed in us. And always, if you have any questions, please reach out to us. We're happy to help. Be safe. Take care. Goodbye, y'all.